Small balance commercial loans, flexible financing for investors as well as business owners. And not every commercial real estate transaction is going to require a $10 million loan. And across the country, investors and business owners regularly need financing for smaller commercial properties, like an office condominium or a neighborhood retail building, or a small warehouse, or a mixed use property, or a medical office, or an investment property. And the challenge is that smaller commercial loans don't always neatly fit into a lending model used by a larger bank. And that's where small balance commercial loans can become an important financing tool. And in Medallion Funds, we help commercial property investors and business owners evaluate financing options and identify lenders whose programs fit the property, the borrower, and their business plan. So, what is a small balance commercial loan? Well, a small balance commercial loan is generally a commercial real estate loan that's designed for properties requiring relatively modest financing compared with, say, larger institutional commercial transactions. So there really isn't one universal definition of what small balance means, but individual lenders establish their own minimums and their maximum loan sizes. And these loans can potentially finance both owner-occupied real estate and investment properties. So depending on the lender and the program type and the property type, we have many options. But say some typical properties would be, say, a small retail center or a small office building or an office condo or a medical and dental office or a warehouse or industrial property or a mixed-use property or a small multifamily property or small restaurants or other owner-occupied properties, but also single-tenant commercial properties and neighborhood investment properties. And the appropriate financing structure really depends on much more than the loan amount itself. So let's talk about why small commercial loans can be surprisingly difficult. And borrowers sometimes assume that a smaller loan should automatically be easier to obtain. But commercial lending doesn't necessarily work that way. And a lender still needs to underwrite the borrower, the property, the collateral, the cash flow, the credit, the ownership structure, and exit strategy. And many of those underwriting costs exist whether the loan is $500,000 or $5 million. And consequently, some lenders establish minimum commercial loan amounts or concentrate their resources on larger transactions so as they don't spend so much time. And this can create a financing gap for otherwise similar smaller properties. And that's where a commercial mortgage broker can help by identifying lenders that actively pursue the small balance segment rather than trying to force the transaction into a lending program that really isn't designed for it. So owner-occupied financing versus investment financing. And one of the first questions we ask is who's going to be occupying the property? And that distinction can substantially change the financing strategy. So let's talk about owner-occupied commercial real estate. And if your business occupies the property, financing possibilities may include, say, conventional bank financing or credit unions or an SBA product or other commercial lending options. So for qualifying small businesses, SBA 7A and SBA 504 financing may also warrant consideration, particularly when preserving your working capital is important. But also commercial investment properties. And for investment properties, lenders generally focus heavily on the property's ability to service its debt. And that brings debt service coverage ratio, or DSCR, into the discussion. So a simplified formula for that is DSCR is your net operating income divided by your annual debt service. So say, for example, if a property produces $120,000 of net operating income and assume that their principal and interest payments are $90,000, 120 divided by 90 is a 1.33 DSCR. And the lender's required debt coverage will be different for every property type and the market conditions and underwriting factors. It's all case by case. So let's talk about the importance of loan to value. And loan to value is another fundamental commercial lending metric. That's really dividing the loan amount by the property value or the purchase price. And that's your loan to value. So suppose an investor purchases a commercial property for $1 million and requests a $700,000 loan. That's 70% loan to value, 700 divided by 1,000. So higher leverage generally means greater risk for the lender, and as a result, leverage can affect your pricing as well, but also your required reserves and the underwriting standards and the amount of equity that you're going to need to bring to the table. And this is why commercial financing should be analyzed as a complete capital structure rather than simply asking, hey, what's the interest rate for this? So, what lenders do evaluate? Well, small balance commercial lenders may evaluate several factors simultaneously, including the property's cash flow. And does the property generate enough income to support the proposed debt? The borrower's credit, both personal and business credit, can influence the available programs and product choices. Liquidity. Lenders may want borrowers to maintain liquidity after closing rather than deploying every single available dollar into that acquisition. And net worth. Some lenders evaluate the financial strength of the guarantors relative to the requested loan amount. And property type. A stabilized multifamily property presents a different risk profile than a restaurant or an office condo or a special use property. And occupancy. Investment property lenders may examine occupancy and tenant concentration and lease expirations and historical operating performance. But also experience, prior ownership or management or investment or business experience may help strengthen your transaction. But also your exit strategy. And this becomes particularly important when we're dealing with bridge or transitional financing. And understanding these variables before approaching lenders can make the financing process more efficient. So why borrowers should definitely look beyond their primary bank for a small balance loan. And your bank may be an excellent lender, but it only represents one credit box. And commercial lenders differ significantly in their appetite for property type and leverage and geography and borrower experience, but also debt coverage, recourse, loan size, and any documentation needed. And a transaction that's declined by one institution doesn't mean it's automatically not financeable by somebody else. It may simply be a mismatch between the deal and the lender's credit policies. And that distinction is one of the primary reasons that borrowers work with commercial mortgage brokers. And the lowest rate isn't always the best loan. And commercial borrowers naturally focus on interest rates. And rates matter, they do, but they're only one component of the financing decision. And investors and business owners should also consider the amortization, how long of the loan they're willing to pull it on, but also how soon is your loan maturity, and do you have to guarantee it, and what are the prepays, and what's the cost, and the reserves. Do we have to guarantee it? What are the covenants? Do we have extension options? How long is it going to take to close? And what kind of down payment do I need? In a loan offering a slightly lower rate, but with a larger prepay penalty or a different structure, it may not be as attractive. And the objective should be finding financing that supports your property and your investment strategy for the expected hold period. So acquisition financing, small balance loans, can be used to acquire income-producing or just owner-occupied properties. So before making an offer, investors should understand how much leverage may be available to them and how that proposed debt is going to affect their cash flow. So consider financing early before signing that purchase contract whenever possible, and I can help you there. We can help you structure appropriate financing contingencies and avoid discovering that you may have a capital shortfall right before closing. Commercial real estate refinancing. And small commercial properties may be great candidates for refinancing, especially if your bank has you on a maturity that repeats and repeats and you have to refinance it over and over again. And replacing with a small balance commercial loan without a balloon payment can help extend your amortization and release equity through a cash-out refinance, or help you consolidate property-related obligations or finance improvements or expansion. And a refinance should be evaluated based on the borrower's objectives rather than simply comparing the existing rate with the proposed rate. Cash-out commercial refinancing in commercial real estate can represent a significant trapped equity situation. So depending on lender guidelines and property performance, investors may be able to pull cash out of their refinance. And that capital can be reinvested for another acquisition or for renovations or for business expansion or for reserves or for whatever you need it for. However, additional leverage also increases your debt service. And the key question isn't merely how much equity can I pull out? A better question is how much leverage can the property responsibly support while accomplishing my investment objective? So we don't want to push your loan too far is the bigger topic there. Small balance loans for self-employed borrowers and commercial property owners are frequently entrepreneurs. And that means their financial profiles may not resemble those of traditional W-2 employees. And business owners may have multiple entities and depreciation and business expenses and variable distributions and substantial assets and complicated tax returns. And commercial lenders, and particularly banks and credit unions, may evaluate these borrowers differently depending on their products and loan programs. And that's another reason that lender selection matters. If the objective is to match the borrower's financial profile with an appropriate underwriting methodology, that's where a commercial mortgage broker can really help you. So why work with Medallion Funds? And commercial financing isn't a commodity. And two properties with identical purchase prices can require a completely different financing strategy because of the borrowers or the leases or the cash flow or the property type or the business plans are just different. And in Medallion Funds, our role is to understand the transaction first, and then we can evaluate the property, the borrower, the loan request, the leverage, the cash flow, and your objectives before determining which financing strategy is the right way to go. So instead of asking who has the lowest rate, let's start with what financing structure can give this transaction the strongest path forward. And that approach can be particularly valuable, especially with small balance commercial real estate, where lender appetite varies significantly and people get picky choosy. So do you need financing for a smaller commercial property? Well, I'm your guy. Whether you're purchasing an office condo or refinancing a warehouse or acquiring a neighborhood retail property, or just buying real estate for your business, don't assume your financing options begin and end with your local bank. And the right capital structure can be just as important to the transaction as the property itself. And that's it for the day. Thank you for watching. Please visit my website, billrapponline.com. That's a way for us to continue the conversation, and I look forward to that day. Take care.